my name is Atish Jogi. I'll be taking you through the Conserver portfolio, focusing on what's happened within the portfolio over the first quarter of 2022. As a reminder, and looking at the portfolio structure, the Conserver portfolio fits within our multi-asset class range. The portfolios in the multi-asset class range have an allocation to more than one asset class. In most cases, asset managers allocate investments between equities, bonds, cash, listed property, and other asset classes based on, for example, their risk-return outlook for each asset class at any given time. The asset managers aim to add value through active asset allocation by overweighting and underweighting the asset classes, and of course, through active security selection within each asset class. The Conserver portfolio was established in September 1997. Of course, its key objective is targeting a CPI plus 4% return over a rolling 3-year period. It is characterized as a low to moderate risk portfolio with an investment horizon of 3 to 5 years. It has a market composite benchmark. Let us look at the portfolio structure in a little bit more detail and look at the exact managers which make up this portfolio. In terms of our local balance component, which makes up 66.6% of the portfolio, we find that M&G manages 28% of assets, Truffle manages 21% of assets, and 91 manages 17.6% of assets. On the offshore side, we have building blocks made up of global equity, global bonds, global cash, and our global flexible building block. In terms of our alternative asset classes, those are split between hedge funds and private markets. We have two different hedge funds serving a purpose of risk mitigation within the portfolio, and also a private markets component, which gives us an ability to provide returns which are uncorrelated to the traditional market. Let us take a look at the performance to the end of March 2022. What we find is that Conserver marginally underperformed the benchmark over the quarter, but outperformed over the year in an environment in which major asset classes were positive and domestic growth asset classes delivered the best returns. The portfolio is ahead of its CPI plus 4% objective over all long-term measurement periods. Over the 1-year period, share selection drove the outperformance, while asset allocation detracted. Within equities, the portfolio was neutral offshore equities. However, an underweight to local equities detracted from relative performance, as SA equities delivered the best return after the property sector. Property exposure contributed to alpha in a property rally that was driven by a recovery in the sector after severe lockdowns in 2020 and 2021. An overweight in local bonds contributed to relative performance, as the All Bond Index performed the Conserver benchmark. In the first quarter, the portfolio was marginally behind its benchmark in a difficult environment where offshore equities came under pressure and returns were negative. Share selection contributed to an overweight in select shares, with mining, such as Glencore, Impala, and Sappi, while banking exposure in Standard Bank and Nedbank added to performance. Asset allocation, however, unfortunately detracted. This is attributed to an underweight allocation to domestic equities, an asset class which rallied, while an overweight to local bonds contributed to relative performance. This was driven by strong yield despite concerns about inflation in a strong oil price environment. I'd like to take a look in a little bit more detail around the main contributors to performance over the last quarter. The local balanced asset managers delivered positive absolute performance over the quarter. Asset managers with higher exposure to equities, which had good stock selection, outperformed over the quarter. Truffle and M&G outperformed, while 91 struggled against the respective benchmark. Truffle outperformed due to their stock selection, with large and small mid-cap exposures in the market. In an environment where risks were elevated globally, the manager increased its cash position to improve protection. Overweight in APSA, South 32, Impala, RMI, and Raynet added to relative performance. M&G also outperformed due to their asset allocation of being overweight equities and underweight cash. In line with its value style, the equity selection was positive. Overweight positions in Sappi, Sasol, Investec, and Glencore added to relative performance. 91, which brings its quality component to the portfolio, underperformed due to asset allocation and stock selection, being underweight SA equities which delivered its best performance. The manager's stock selection was also negative in an environment in which its Rand hedge shares delivered poor returns, while underweight to resources detracted in a commodity rally. Being overweight Richmond and BTI and being underweight Impala and Anglos also distracted from 91's performance. Last but not least, let's take a look at our asset allocation at the moment. Currently, we have a 16.1% allocation to offshore within the portfolio. Our equity allocation is sitting at 36.5%, property at 1.9%, bonds at 37.7%, cash at 13.8%, commodities at 0.6%, alternatives at 9.5%, and of course, what's important to us as an investments team is making sure that our portfolio remains diversified across regions and across asset classes, and of course, multiple asset classes being employed both locally and offshore allow us to spread risk effectively. Please feel free to reach out to any members of the Alexander Forbes Investments team if you have any questions on this portfolio. Thank you so much for joining the vodcast. I really appreciate your time and look forward to presenting to you again soon. Goodbye.